Angel is brought to you by NetSuite from Oracle, the only system you need to run your business. Go to netsuite.com/angel to get your free guide called Crushing the 5 Barriers to Growth.
Hey everybody, welcome to the podcast Angel. I'm your host, Jason Calacanis, an angel investor, an early stage investor here in the Bay Area, Silicon Valley as it's called. And I've invested in over 150 companies. And I started this podcast because there's a bit of a revolution going on. People have not been able to invest in technology startups because, candidly, they haven't been going public. They've stayed private longer and longer. Additionally, some regulation has passed here in the United States that allows even non-accredited investors to finally be able to dip their toe and invest small amounts of money in private companies. Now, this is a risky asset class. When you buy shares in these private companies, you don't have a ton of information. They're very young. There might be 2 or 3 people in them. And these are not liquid stocks. In other words, if you want to sell a share in a private company, you have to get the company's permission typically, and there's not a market for it. In other words, if you were trading Netflix or Amazon today on the stock market, you can buy and sell as you please. Private companies you're going to hold for 7, 8, 9, 10 years or more, and the majority of those companies go to zero. But in this crazy world of Silicon Valley, we frequently see companies and angel investors who have invested in them become worth $1 billion or more. To give you some idea of this, I've invested in 150 companies. 6 of them have become unicorns. That's a pretty good track record. You're not guaranteed that, and it's also during a boom cycle here in Silicon Valley. So there's tons of caveats there. But if you invest smartly, wisely, take your time, and you learn, you can be part of the most exciting revolution happening on the planet today, which is entrepreneurs solving the world's biggest problems, whether it's Tesla or Uber or Airbnb or Google, Facebook before them. It's a pretty exciting place to be. I give this whole wind up and warm up because my guest today, Geoff Clavier, was one of the first micro VCs. In fact, he kind of defined the category. There were only 2 people who had smaller funds that focused on the earliest stage investments. They were Ron Conway and Geoff Clavier's soft tech fund, which is now called Uncork Capital, Uncork Capital. And I guess also First Round was in there too, in terms of the people who do early. So welcome back to the program, Geoff Clavier.
Thank you so much, Jason. Good to be here.
Yeah, we know each other for over a decade.
Over a decade, yeah.
Yeah, and you...
Almost 15 years, actually.
Almost 15 years. How did you get started as an investor? Were you an entrepreneur who went into investing, or were you always in finance? How did you... I don't actually know.
I did a startup in the financial services market back in France. So I was born in France. And we brought...
You're French?
I was born French, yeah. I'm not
I
American.
never would have guessed. No, keep going. Joking.
I can do the podcast with a French accent if you prefer.
No.
And so we brought Sun workstations and trading floors in the late 80s. And this was actually really successful as a company. Moved to the US and this eventually were acquired by Reuters. It's either Reuters and Bloomberg in that space. So did that, was a CTO, stayed for 7 years. And then in 2000, moved to the Valley to become a traditional VC.
Just in time for the market implosion.
Essentially, that's what got me here.
Explain.
The guys at the Reuters Greenhouse Fund, which was the corporate venture arm of Reuters, invested their fund from London, taking turns flying from London to San Francisco. And when the boom, the bust happened, essentially they needed an operator on the ground, and they chose me because I didn't have any idea whatsoever about the VC market, investing, whatever, but it was actually a very strong operator. So I came in and joined to essentially clean up the portfolio back in August of 2000.
And at that time, everybody was running for the hills.
It was absolute bloodshed everywhere, companies imploding left, right, and center, people losing their job, VCs counting their losses, and a lot of traffic going to bankruptcy court in San Jose, where I spent way too much of my time.
Yeah, explain why, when you look back on it, this actually happened. What was it that caused that massive implosion, and why did so many startups not be able to navigate through it?
I think that at the time, there was just this craziness where people were super excited about the potential of Web 1.0 and came up with a ton of unsustainable, product, services, and financials. And eventually everybody was sort of jumping on everything, financing them, not thinking about, hey, what does it mean to acquire a user or a customer or whatever? And because the bankers and the public markets were super ecstatic about this notion of a revolution in the new sort of industry, they were just moving them to the public, to the public, so they can actually trade and be accessible to public market investors within 18 to 20 months, right?
Of the company forming.
Of the company forming. So you were sort of forming the company. Within 6 months, you were raising your Series A. Within 12 months, you were raising your Series B. And you were already talking to the bankers about going public. And the problem is that none of those companies had any business. And I think when I looked back, and what got me essentially to start SoftTech now Uncork was this notion of, hey, if companies raise too much money ahead of having product market fit, then you can almost guarantee that it's going to be a disaster. And that's what happened at that time.
And is the reason that founders with too much money get distracted, or you're just signaling that you're not a great founder because you're too focused on raising that much money? What is it that too much money causes? It seems to be a universal experience. When people raise too much money early, they just never get product market fit.
Yeah, you have to go through the pain of figuring out what is the right, product functionality, which is going to, get you users and retain them. You have to figure out how to acquire users, which channels are actually the proper ones. And it has to be sort of painful and difficult. And being scrappy often leads to greatness. And so you want to make sure that you have enough capital to see through the different hurdles. And today this is true in the seed market, see through the different hurdles for your next round. But if ever you have too much money, then you're just going to spend the money. And, it's very easy to spend $100 to get 10 or 20 or 70 cents back, which is unfortunately a lot of the unit economics that we see today in companies that are struggling.
Yeah, we saw this with Cosmo, Urban Fetch, those companies during the time who were doing delivery like Instacart is doing now, where they were charging half price for the goods, free delivery at no minimums.
Yeah.
And we were trying to figure out, hey, how is this sustainable? So let's fast forward now, 2 decades later, here we are, and we see founders.
Still looking good.
Still looking good. We're doing okay. So it's like a little gray hair going here. But we fast forward 20 years from that moment in time, and I see founders who have not built their products write a white paper and then raise $10 to $200 million in an ICO.
Yes.
Does this, in a way, what you outlined was 6 months to see a Series A, a year to B, and then 2 or 3 years to an IPO to raise 50 million. Now we see people doing that with a white paper only in the ICO space. And it seems to be those are a global group of crypto civilian investors putting their money into these. In other words, retail investors.
Some funds.
Some funds. But in these ICOs, do you feel concerned like you did in the dot-com era?
Oh, this I'm going back, 20 years almost, seeing exactly the same signs of, people are just so excited about the potential, they don't think about the downside risk. And to be honest, because a lot of those retail investors have made their money on, running Bitcoin and Ethereum portfolios and so on and so forth. And this run-up has made them have the feeling that A, they're successful and they know what they're doing, and B, it's almost sort of free money. So why not then invest in ICOs? Because it's just the next logical step. And I'm pretty sure there will be a couple of defining companies that do ICOs and do extremely well, but 98% will blow up, and a bunch of them will be like this company we heard about. I don't remember the name, but basically there is an ICO, took the money and ran, and the company has just disappeared.
Yeah.
So we'll have a lot of fraud, and the SEC is starting to step in to try and see how they're going to regulate that.
Yeah, and the rigor that you put into picking companies to invest in is a lot more than reading a white paper and then sending money to a wallet.
Yes.
Explain the difference between your process and what's happening in the ICO space, which is a bunch of uninformed people get into a Telegram room. I'm saying that, not you, but people who have no experience investing, generally speaking, outside of crypto, get into a Telegram room and they just ship some Ether or Bitcoin into a wallet and wait for coins to come back in 2 years. What do you do when you're assessing a company? What's your process?
So the process, I mean, we could spend 2 hours on that, so I'm going to be short.
Yeah.
First and foremost, you have to define your investment strategy. Either you can be like super broad and invest in anything that comes to you, assuming that you have a good inbound deal flow, or you're going to sort of figure out what are the sectors that you want to go after. And so for us, it's SaaS B2B enterprise, bit of marketplaces, B2B and B2C, bit of consumer, but all monetized. So we don't do the unmonetized consumer anymore. Connected hardware, both consumer and industrial. And more recently, in this most recent fund we raised, frontier tech, which is sort of a catch-all these days, where it's AI, AR, VR, autonomous infrastructure, a bit of space tech, robotics, and so on and so forth. So we basically say, we advertise, this is what we're interested in. We receive, anywhere from 3,000, let's say 3,000 referrals per year, give or take, right? And eventually we'll close, call it 12 to 15 investments per year. So we say no 99.5% of the time. If you look at the funnel, so 3,000 in, we say no right off the bat 70% of the time. It's not the right stage, not the right sector, not the right geography, not the right, company type, opportunity, and so on and so forth. So we just say no within 10 seconds. Then we spend a bit more time. We read about the founders, we read about the opportunity, the market, and so on and so forth, ask for their deck, analyze it, and then we'll pass again on, at least half of that. So we're going to see maybe 500 to 600 entrepreneurs in the office, me and my two partners. One of us will take the first meeting. Then, most of those companies will be passed on. About 150 will get to the second and then third meeting. 50 will go into due diligence. 18 will get offers. 15 will close.
So you keep statistics on this, obviously, and you think about it with your partners of what is our funnel? What is our process?
Yes.
And so the way you described it, 600 meetings, which were culled down.
600 first meetings.
First meetings, in-person meetings.
Yes.
Those were culled down from thousands of pitches coming into your email box. So thousands to 600 meetings, those 600 meetings resulting in 15 investments.
Yes.
So you're looking at, whatever that is.
It's basically a 5% from the meeting to the investments, 5%. From the top of the funnel to the investment is 0.5%.
And when founders get a meeting, where they get 2 meetings or 3 meetings and then get a no, this can be very disheartening from them. How do you manage that process of taking a lot of time with the founders, but then passing? How do you do that gracefully?
And I can't compute, it's 2.5%. It's
2 or 3%, low single digits.
So it's always tricky because you try and sort of give a quick no as quickly as possible because you don't want to waste the entrepreneur's time. You want to be respectful. The problem is that the quick no is always sort of the easiest to give. But as you go down the funnel and, you say, well, let's meet my other partner and then my third partner, and then let's do some reference checks and then do, another meeting to go deeper in the technology, the product, and so on and so forth. So you go from wasting 1 hour to sometimes 10 hours of the entrepreneur, and then you feel really bad because at the end of the day you just couldn't get there. And you try and explain why you passed, and you try and be useful, helpful, and say, well, this is what I learned, this is why I'm passing, and you're sort of half apologetic, but at the same time it is what it's about when you fundraise. So it's being as decisive as possible and trying to avoid like taking time because you can. Because sometimes VCs will always spin an entrepreneur for a couple of months before passing. So we try and get all those processes to be run over, a couple of weeks. But sometimes we can't. Sometimes we're talking about like new sectors. Space tech is a good example where if you invest in something brand new, you have to learn about the space. You have to meet with people who have done it before, get, sort of experts involved. And by definition, those a process like that will take 3 to 4 weeks. And there's no way to do it faster unless you just invest sight unseen. Some people do that.
Really? They just say, I'll just make a small bet here. And yeah, I mean, we do see that in angel investing. Somebody knows somebody, so they invest in somebody they know. That seems legitimate.
Which is fine. You know, everybody has their own. As long as you define your strategy and you stick to it, almost any strategy is valid. It's more the randomness that is dangerous.
People would criticize hundreds of investments as spray and pray. People criticized, I guess, Ron Conway about that. Not so much you, but maybe 500 startups when you get to those big numbers. But even in the spray and pray, those, I believe, those funds turned out to be ahead. I'm not sure what will happen with 500 startups, but I know with Ron Conway, he wound up being ahead, I guess, hitting Google and having a tiny sliver of Facebook.
Because Ron was able to build sort of an index fund with the right companies in the index.
Right?
And so what Ron had is unique access, which means that all the best entrepreneurs and companies would give him an allocation. And, you know, there was a say, there's always sort of room for Ron Conway. So as long as he chose that a company was worthy of his cash, he could actually get it in. It's not something that is available to everyone. So
explain that dynamic here, because this sounds to people who are just getting into angel investing or maybe are outside the industry, they may not understand. Why is it that access to the top deals was so important?
Because at the end of the day, if you look at the distribution of successes in the industry, i.e., which companies will actually return so much of a fund's performance that they are the only ones that matter. In a typical fund, let's say 40 investments we make per fund, only 4 or 5 companies will really matter because they will return the fund, 2x the fund or more. And when you sort of look at that distribution of performance, the rest is not really sort of impacting your performance at all. And therefore, if you compound that with the fact that about 15 to 20 companies really sort of matter per year in terms of creation, sort of growth and eventually exits, if you can tap into 1 or 2 of those per fund cohort, then you will be very successful. And that's what Ron has been doing for a bunch of years, is figure out, which companies, which founders will be really good. And the challenge is have enough of those winners. And so this spray and pray strategy that you mentioned, which is, hey, here is 10, 100, 1,000 checks of $100,000, can be very profitable per investment, but if you have $100 million fund, you may not return much of the fund with that small check. So we have a different strategy. We'll do 40 investments per fund, but we'll get anywhere from 7 to 10% of a company when we write that check, which means that $1 billion outcome will return the fund.
Right. And you have to think about returning the fund as a fund manager, because you don't get paid anything except for the management fees which are in advance, until you clear whatever the total amount of the fund is.
Yes.
If you have a $200 million fund and you get to $199 million, you get nothing.
You get nothing. Zero. And you don't raise another fund, most likely because your LPs are not happy with you.
All right. When we get back from this quick break, I have a question to ask you as a new fund manager. I just finished my first launch fund 1,
awesome,
which was a $10 million deployment.
Congratulations.
Thank you. I want to know what, after your first fund, now that you're on your 5th, what you learned in that 2, 3, 4 fund that you wish you had known back when you were getting started. What do you know now in funds 4 and 5 that you didn't know in 1, 2, and 3 when we get back on Angel? Hey, everybody, let me take a moment to thank my friends at NetSuite by Oracle. Yes, the results are in, and Survey Inc.'s 5,000 company survey shows that the top barriers to growth are: finance takes too long to close the books. That's number 1. Number 2, your company is too slow to launch new products. Number 3, hiring and keeping good people. Number 4, managing cash. And number 5, too many disparate, disconnected systems. So it's hard for founders and management teams to get a full picture of their business. It sounds like all of these companies are outgrowing their business and financial management systems, doesn't it? Well, QuickBooks and spreadsheets, they can only get you so far. They're great at the start, but it's now taking you 2 or 3 times as much effort to get this basic reporting. And you cannot get accurate answers to your questions as a management team. Does this sound familiar? It does to me. And that makes it impossible for you to make strategy decisions going forward. You should know that the number 1 system for growing your company is NetSuite from Oracle. Yes, that's right. NetSuite from Oracle is the one system, the one singular system that will track and manage revenue, cash flow, HR, inventory, and even your projects, even e-commerce for every single industry. That's why NetSuite is so powerful. You can run your business from a dashboard even on your phone. And you need that dashboard so you can make those critical decisions as the business leader. It's never too early to invest in NetSuite and to start using the professional grade business management systems that they provide. So go to netsuite.com/angel, netsuite.com/angel, and get your free guide called Crushing the 5 Barriers to Growth. That's netsuite.com/angel, netsuite.com/angel. It's the only system that you need to run your business. Get that free guide, Crushing the 5 Barriers to Growth, at netsuite.com/angel. Thanks again to NetSuite for supporting season 2 of Angel. Okay, let's get back to this amazing discussion. Hey, everybody, welcome back to Angel, the podcast. You can visit us, angelpodcast.com, and you can find us in iTunes. Write a review. Hey, rate us. That always helps. And spread the word. Email your friends. Tell them Angel Podcast if they're founders or they're high net worth individuals looking to invest in the riskiest asset class on the planet, or I should say, now the second riskiest. Now we're the second riskiest. We used to be
ICOs.
Yeah, we used to feel like we were the ones doing the dangerous work. Now people, a white paper, Geoff, can we just let that soak in for a second? You and I could sit here and write a white paper with our pedigrees, which are long, 350 combined investments, multiple unicorns between us. We could write a white paper this weekend, get a couple of bottles of wine, a little brie, huh? I have a feeling, where we can get some good French bread. We sit there, we drink a little wine, we have a little brie, we write a white paper. Bing, bang, boom, $200 million in Ethereum in our bank accounts.
That's all?
That's it.
I would say more, but okay. Yeah.
But
sure.
anyway, take the $200 million Ethereum, we chop it up, and that's it. Have you thought about doing an ICO or a coin or a cryptocurrency to back the fund, in all seriousness, in order to allow liquidity for the LPs? And would LPs even care about that? Because we saw, I guess, Brock Pierce made a small $10 million fund or something. Maybe it's a $40 million fund for an investment fund that is crypto-backed. Do you think that's going to be a thing? And have you thought about it? You must have thought about it. Have you considered it, I guess, would be the better question.
So that's actually touching on one thing which is interesting with cryptocurrencies and things which are doing ICOs is the fact that you can actually commit early, get sort of the potential risk kind of curve where if it's super early, it's cheaper, and as the company sort of proves itself, then becomes a bit more expensive, and you can start getting liquidity in the middle. That's the only characteristic which is so interesting to me, because obviously, as you said in your introduction, it takes a long time for funds like ours, seed funds, to mature. Like a great seed fund will have returned its capital, after year 6, 7, 8, right? Depending on the maturity of the companies and when they actually exit, which means that LPs are stuck for years and years. My first fund 1, took 13 years to get out of the entire portfolio. Right. 24 companies, the last one sold in 2017. So LPs would love to get early liquidity if they could. And the problem is that when you invest in seed as an LP, it's not possible. So that's intriguing. However, I think that today you have, because the market is very efficient, you have secondary shops that buy the position of the LPs and can actually get appreciation on a fund like yours or mine mid-flight. And so there are alternative, more traditional mechanisms than ICOs. When I just talked to my lawyer, Steve Franklin at Gunderson, and Steve is one of the most experienced fund formation lawyers in Silicon Valley, and I said, so ICOs, tokens, partial liquidity, just stared at me like you want to go to jail kind of stare. Yeah. So I think it's a bit too early to figure out that, but I think the intermediate liquidity is something that I would look at. But the whole notion of not getting professional investors, institutional investors as backers terrifies me.
Yeah, see, it's interesting. I was in the terrified camp. And then after doing an AngelList syndicate for so long, and now it's on Jason's syndicate, we moved off AngelList to run it independently. And we have 2,000 members. And now that it's got 2,000 members and it fills up a syndicate very quickly, we do 200 or 300K per hour in an investment. So 99 slots, it's only on average 2K per person, 3K per person. And people are doing it to learn, and I'm obviously investing, so that should be some sort of signal for people, not the ultimate signal, but a signal. And I've started to think, gosh, if you could have all 2,000 people put $100 in each, and those 2,000 people were civilians, our siblings and cousins and uncles and aunts, and they got to get in early on some of the companies we have, that would be fun and educational for them.
True.
Right? And so as long as the dollar amounts were contained and you weren't, and you had a fund manager watching it, I would feel almost okay with civilians doing it. I wish we had the fluidity in which we could say, civilians can invest in startups with a fund manager, like ourselves, saying, okay, I'll make sure the paperwork gets done. I'll make sure that the founder does monthly updates, or try, not always succeed, but beg the founder for updates. How do you manage the update situation? Because it's changed over time. In the early days, you didn't even ask. You have to.
Well, we try. So we meet with our founders regularly. We remind them that they have to send at least a quarterly update to all the investors. We offer them tools. Like we've partnered with a company which makes it super easy to send, updates and give you sort of the graph. Visible,
I've heard of it. Yeah.
And so it's a reporting framework which is really interesting. We mandated that our company sort of use Carta, and Carta is developing a solution. So there's so much can. Carta, it's the old e-shares.
Oh, the e-shares, they changed it to Carta.
Carta.
Oh, you mandate that they use it?
Yeah. Oh, yeah. It's in the term sheet.
Yeah.
So they have to use Carta because it makes our life, theirs and ours much easier, and so it's good.
What is Carta, formerly e-shares? What's the killer feature for you? The cap table?
It's the cap table management, the fact that they have an overall reporting of your portfolio, so you can see everything to the fund level. You can then give access to your LPs. So all of our communication to LPs now is done through Carta, and we have anywhere from 40 to 60 limited partners per fund. Most of them are institutional, but we do have individuals. All our funds are QP only, qualified purchaser. So because there are limits for the types of funds that we invest in terms of the vehicles have to have accredited investors. So, I think eventually what you describe will be possible, but given the state of the market, I feel way more comfortable working with, limited partners who will be there for many funds as long as we perform.
Let's talk a little bit about how you learn a vertical, because this is one of the most interesting things, I think, is since you've lasted so long, and I want to get back to my question about the portfolios, but because that's in my own best interest. But I think the people listening probably were like, "This sounds like the greatest job ever."
Yes,
It is, isn't it? Right? Why is it the best job ever in your mind?
Oh, because you have the luxury. I mean, you're so lucky to see the world through the eyes of sometimes really crazy entrepreneurs who will describe a future that is informed by their vision, and you will sort of and ask yourself, and then eventually every now and then you will back them, and yes, it will work. And when you sort of look back at some of those great investments that turn into a massive exit or an IPO, and there is always sort of this magic around the IPO, it's just like
mind-blowing.
Special feeling that you were there, you supported, you helped. There's always one or two things that an investor has done to just shape the trajectory and the destiny of a startup.
Right.
And when you can just say, well, I did this, and that enabled that awesome company and this awesome story. I think it's not so much the pride; it's just like this achievement you've enabled for a team. And I was lucky enough to be an early investor in SendGrid, so we did the SendGrid IPO.
Oh my God,
a few
that's
weeks ago.
huge! Congratulations! Yes.
And they brought pretty much all the employees who had been there for 5 years. So it was actually a pretty big group, and it was so awesome to be in the middle of the pit, rejoicing with them when the first trade happened.
And people don't know this, but no Y Combinator company has ever gone public.
No.
Not one.
It's the first IPO of all the accelerators.
All the
Techstars.
accelerators has only been one, SendGrid. And SendGrid has a market cap of what? 2 billion? 3 billion? I don't know.
No, it's
Like
a bit less than $1 billion.
Okay.
So
it was at $1 billion and the incubator got 6%. They got diluted a little bit. It's a $40 million position. If you think about the Techstars incubator's $40 million position, and they're making $100,000 bets.
I don't even know whether it was that big at that time.
It might have been $50,000 bets at that time.
This was
$25,000.
Yeah, this was like in the very early days.
It's probably $25,000.
It was a 2009 investment, if I recall.
So, but if you think about it, even today at $100,000 investments, that one investment returns, even with the dilution, if it was $40 million. I don't know, my math's not perfect here, but I think that's like 400 companies getting 100,000 each, right? 4 would be 400,000, and 10 would be 4 million, and 100 would be 400. It's unbelievable. 400 startups could have been funded just from that one. So they only have to hit 1 in 400 for it to work out.
When you invest super early, and that's really sort of the genius of Paul Graham and the other accelerators, is to be able to get into those companies at a sub like $1 million valuation, and make all those bets, and then over a batch of 20 or now 200 at YC, only 10% of those companies will matter, but then the leverage they will get on those dollars is just insane.
And in fairness to YC, they have Airbnb and Dropbox, which combined will be
50-ish billion.
I mean 10 billion
40.
for Dropbox and 30 for Airbnb, 30, 40, 50. Who knows what the market will be at.
And there's a bunch of others. They have Stripe as well. I mean,
Stripe's 10 for sure, 10, right?
Yeah. They are 9, 10, and then some. So
and they've had other exits along the way. So I don't mean that to beat them up, but it does say something about how hard it is to IPO. That this is literally the first one, and Dropbox is now 10 years old because they were at the first TechCrunch 40 conference we did. How do you learn a new vertical? Because that seems to me to be one of the great upsides of the job. You talked about being part of something and just the incredible warm feeling you get when you know that you helped make something that changed the world. But this other thing seems super exciting to me too. Like, I know nothing about space. Let me go talk to 20 founders in the space. And, like in the space vertical, this is incredible.
But that's basically,
that's the whole strategy. It's that simple, right? Just sit there and not understand and have them explain to you.
It's sort of that. So first and foremost, you have to understand as an investor what you're comfortable with and what you're not. And I think after doing this for 17 years and having done 200 investments, I sort of have a good feel as to what I know I can be comfortable with. Like I know what my risk threshold is, and it's very important to understand it. And so, I was very intrigued by space, and I saw some of my friends bet on a few early satellite companies, a few rocket companies, and I was like, this is intriguing, and I would not do this because I was exploring other types of new sectors. And then suddenly it sort of became a bug, and I wanted to learn. And so I just reached out to people who were investing in space, to founders who were doing space deals, talked to a few angels who were doing space. And I said, hey, I'll take a look. And, we always have sort of a bar to the first meeting. Then you drop the bar to low, like almost no bar, no hurdle. Just take any meeting from anyone who's doing a space tech startup. And so you just learn about space and the opportunities, and you figure out, okay, there is the satellites and the satellite launchers and the rockets and the equipment and the 3D printed engines and the infrastructure and the communication. And so you look at the space ecosystem and try and meet. I think I've seen 20 or 30 different, opportunities. And I scratched all of them because I was like, no way, no, not interesting. And finally, one day, I was referred to this company, Loft Orbital, which we ended up backing. And there was a really interesting concept of bringing this notion of shared resources to space. So today, if you're launching a satellite, it's basically your satellite. You put, your sensors, and you have to figure out your mission. So, who's going to build it, who's going to launch it, who's going to manage it, and so on and so forth. And then there's there's a life to a satellite. They don't stay up, forever. So the small nano satellites will stay for a year. Those sort of average size satellites that
we call them low Earth orbit satellites, right? Low Earth orbit.
And those guys will launch satellites which last for about 5 years. And so what Love does is they say, well, we just need to use the resources of the satellite on top of the region that we want to monitor for, whatever purpose, and then change the sensor, give power and data access and so on and so forth to another sensor as we rotate around the Earth. And so we can actually run in parallel 4 to 7 missions. So you put all the
time sharing
sensors,
a satellite.
You time share a satellite, and you just build the operating system. And
that switches the software,
To you, the satellite actually appears to be a data stream and an API. So you completely abstract the complexity of, sending something in
satellite as a service.
Satellite as a service. Wait, payload as a service.
Payload as a service, right.
And so that's what those guys do. Then you sort of look at their track record. Antoine is French. Don't hold that against him. Has spent a lot of time in his career at Airbus and Arianespace and in the space industry. His co-founder is a specialist. He's a product engineer in space, and those guys have just been doing space for an aggregate of 40 years. So founder market fit was just up the wazoo. And funny enough, but it reminded me of SendGrid. Because what is SendGrid? SendGrid is a piece of infrastructure for the e-commerce market and now sort of broad internet. And essentially what Loft Orbital does is they build that software layer that just hides the complexity and eventually can literally take the cost of a mission of, call it $30 million down to 5 or 6. And so amazing. On paper, it's amazing. Obviously, it's going to be hard as hell, but I was actually comfortable with the software nature because they're not building the satellite, they're not building the launcher. So they're working with, some partners for satellites, some launchers. And, if all goes well, first satellite launch will be a couple of years.
Let's talk about my question that I teased before the break, which was, what have you learned over these first couple of funds that if you go back in time, you would change about the early funds? What have you learned and that you now take with you into this fifth fund?
So I think what's interesting, Jason, is Fund 2, the fund I launched at TechCrunch 40 with you on stage on September 18th of 2007. And that day you said, where the hell would anyone sort of do a small fund? It was a demo fund. I didn't really have a super strict portfolio construction strategy. I was doing like, if I like the deal, I'll do 100K. If I love the deal, I'll do 250K. Reserve, we'll see. Don't really care about levels of ownership and so on and so forth. And it was good because it was a small fund. I could be very flexible and iterate over time. It was my MVP. Fund 2 was my MVP, right? But now it's all about being very clear in terms of how much we invest, what is the percentage of ownership, what we do, what we don't do. And, this sort of clear strategy really, and we've evolved it over time, has really sort of made crispy clear for LPs as to why they want to work with us.
Yeah.
The one thing which I learned the most, I would say, is always be raising. I was very I was on my own. Remember, I just did I did 89 investment on my own before I brought some partners and some staff. So there was a lot of work to do, which means that I was very transactional in the way I was interacting with LPs. So I wouldn't take meetings, wouldn't talk to them until I was in fundraising mode, and then I was saying, "Hey, invest in me." That's not how limited partners want to interact with you. They want to get to know you over time. When you raise a fund, you're going to be raising Fund 2, and you have to just be prepared to meet limited partners for Fund 3 and Fund 4, because they will look at you in Fund 2 and they will pass. They may look at you in Fund 3 and they will pass, but they may be there for you in Fund 4. And I remember meeting this limited partner who said, I will not invest in you before Fund 5. Fund 5 is sort of this magical number, it feels like, where suddenly it becomes easy because you're bit more proven, maybe, I don't know. But he said, I won't touch you before Fund 5, but I'll be there for Fund 5. Unfortunately, we didn't have room for him in Fund 5. But, it's the whole point of the...
You didn't have room for him, or you made a point of not having room for him?
I'll take the fifth on that one.
Exactly. See, very interesting you're saying this because, we're not allowed to talk about if we're raising funds currently.
No.
So I'll just say, if I was, and if a friend of mine had a similar experience, it would be exactly what you're describing, which is people meeting with the big endowments or people who have large funds of funds. And these LPs would say stuff to my friend like, oh my God, this is amazing. Your track record is unbelievable. And we absolutely cannot wait to be in business with you on your next fund. So we really want you to save us a piece in the next fund. And I would look at them and I'd like, can I ask you a question? If you believe it's amazing and my track record is amazing, why not just put it in a small bet now? And then you would be guaranteed space in the next fund. What happens if there's no room? And they're like, yeah, that's a big risk. So we want to make sure we meet with you twice next year and check in on everything so we can definitely be in that next fund. And I was just thinking to myself, if I actually get the room, I am going to make a point of not having room for you. Like, isn't the whole idea to support people early?
Well,
I guess you got to get to know people.
In our world, yes. LPs just think about opportunities differently, and they don't really sort of have this anti-portfolio concept where it's like, well, I passed on Uber and you showed it to me, and I passed on Airbnb because whatever. Like they will not say, oh, I just passed on Softec or on Launch 3 times or whatever, and then they wouldn't give me a piece of the action. It's just not the way they look at things. Right. So you have to just respect this notion that they are very patient, and if they give you a fund, they give you 2 or 3 funds.
Right.
So the decision that they make to be in business with you
is going to be a decade long.
Yes, exactly. It's a decade.
Yeah, that makes sense to me.
So that's why you got to
be patient with them, I guess.
You just have to respect that. And I think going back 10 years, when you and I were on stage, and I was absolutely clueless about this whole world of fundraising, because raising Fund 2 was just a piece of cake. It just happened over the summer of 2007. No one knew what we were doing anyway, but it was like that was this transition of the super angels to micro VCs that happened at that time. Right. And people were just fascinated by our deal flow, our early track record, and said, gee, for the longest time we were ignored, but then we just backed awesome companies after awesome companies. And then they wanted to work with us. And one way for them to work with us was support us through those early funds. And so that's what happened. Literally 8 weeks, boom, done. And it doesn't happen like that in real life. And truthfully, it took me 2 years to raise my next fund. But you really need to understand the cycles and the portfolio construction and so on and so forth that they go through, because as one of their fund investment, you're in a given box, right? You're like early stage, tech, US, blah, 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 blah. And you have to be very precise. You have to be, especially in this environment where you have 570 pre-seed, seed, and post-seed funds, you have to have a shtick, which is, this is why I'm, the best for this particular category, and founders who are interested in working with someone who can help them there will come to me. Those LPs will want to understand why you're the best investor for this particular category, and you have to demonstrate through your track record that you have the track record, but also the replicability. Because people will say, "Oh, you've been awesome, but you may have been lucky," and it takes a while for people to see this sort of consistency.
I think my friend is having a little bit of that exact experience where people are like, because my friend hit one of those decacorns you mentioned, and they might be like, I wonder if that kid got lucky and now or if it's skill, fascinating. Let's go through your portfolio a bit. You did Fitbit. Amazing. Yep. I'm wearing one now. How did you find that company? And that was a hard bet to make, I think, at the time, because it was hardware. And hardware 10 years ago was, correct me if I'm wrong, really hard. And it's hard now, but it was absurdly hard.
It was absurdly hard. And so So Fitbit, I met in 2008. And so that was 4 years after starting SoftTech Uncork. And at that time, I had this nagging question, which was, capital efficiency has allowed us to build awesome companies, relatively cheaply compared to, the 96 to 99 cohorts. I wonder whether hardware is the same. Like, would capital efficiency apply to hardware?
Right.
And I had that question, right? And
what was
then
the answer?
and then
we'll get to it.
we'll get to it. And then a few months later, a friend of mine sort of writes me and says, hey, those two guys, pretty awesome entrepreneurs, building a connected pedometer. It's called Fitbit. Want to meet them? And as you said, there were barely 1 or 2 hardware investments coming to you per year at that time. So I was like, sure. And so I met James and Eric in Palo Alto. I think it was June 2008. And they pitched me on the concept of, the pedometer that is connected gives you, transfers information and gives you sort of visibility and everything, wellness focused. And I was like, okay, so pedometer you can buy at Walgreens for $15, and this is going to be $100. And it was ugly as crap, because it was an ugly prototype like every hardware startup that you meet. But I was really intrigued because James and Eric are really, really smart. But I was like, would anyone sort of buy that? Like literally, why? So I was not convinced. So, I think I may have met them a second time. I wasn't even sure. But then, go on vacation, come back, they crunch 50, and here's Fitbit on stage. And they show like a nice rendition of the product. They have a really polished pitch. And I see my friends, or our friends, Ev Williams and Kevin Rose, as judges. And they're literally salivating.
Yeah.
Like they want it. They want to lick it. They want to use it. They want it. And I'm like, I'll take that as a market proof.
Right.
And I run after James, and we sat on the side. There were like these meeting tables on the side, right? Yeah. So was there, and I basically said, so where's my investment? He's like, which investment? He's like, well, I'm going to invest in Fitbit.
Yeah.
You didn't get my email? I never sent that email. And he's like, well, we're almost closed or whatever, but we'll make some room for you. And so I just caught the opportunity at the right time.
Yeah.
And
sometimes you have to go with your gut, right? You get a gut sense that these are the people, this is the time, it's the moment, it's the product.
And you use, Ev and Kevin salivating as a proxy to market, pool. And because it was late in the process, my dear friend John Callahan was from True Ventures was the lead. There was just a small $125,000 available, and I get in and say, how can I help? Oh well, we're launching for Christmas, and you can help with that. So start getting involved, and this is when it hits, which is hardware is so freaking hard.
Yeah.
And the problem is that I, as an investor, had no clue because that was my first hardware deal. And the problem is that James and Eric had no clue either because there was their first hardware startup. And, as I always joke, they promised to deliver, the first batch of Fitbits for Christmas. Thank God they didn't say which one. And so they thought to release the first Fitbit Christmas 2008 and took until Christmas 2009.
It always takes longer to build, and it always costs twice as much as they think, or 3 times.
Or 3 times. And remember that they actually achieved what they said they would do. So it's very rare amongst hardware startups that they actually sort of deliver a product that does exactly what they promised.
And a product that makes people happy. I mean, if you look, even like Ring, which is a very successful product now, the first version of that James did, Door something, I can't remember, Doorbot, maybe it was called. I mean, it got terrible reviews. It got savage because it was just, when you add, software is hard enough. You add hardware to software, and now you got 2 different things you've got to get right. Let's talk a little bit about Chartbeat as well.
And so the answer is no. It's not capital efficient at all.
It's not capital efficient at all.
No, it's hard.
It's hard. And, I think there was this mirage, a collective mirage around Indiegogo and Kickstarter because we'd see Oculus, Pebble, and other projects just do extraordinary. And so you'd have consumer demand would give you this false sense of, okay, we can do this. We've already eliminated consumer demand. We know there's consumer demand for this because people are paying in advance.
Yep.
And then what I realized was almost universally, I would meet startups and say, how much are you raising your Kickstarter? Well, we raised $300,000. Okay, what's it going to cost you to deliver the product? He's like, well, we charge $200 for the early bird, and the build of materials will probably be $250, and then we got to do marketing, so it probably costs about $500. I'm like, so the Kickstarter people are paying $300 less per unit than it costs you to build them. Like, what do we think is going to happen here? Like,
that's called digging your own grave.
Yeah, I mean, literally, you're like, but the plane's going faster, so this must be good. It's like, no, the plane is pointing towards the earth. Yep. It's going faster because of gravity. You're going to crash into the ground. We need to go up.
Which is why, unfortunately, so many hardware startups had a hard time sort of scaling. And like, if you actually think about very successful outcomes, obviously you have Nest, you have Fitbit, you have Dropcam, and so recently sold August to Assa Abloy. So there's been, sort of good outcomes to great outcomes, but they're just like, you don't even have...
Oculus would be a good one.
Oculus was a good one, obviously.
So we have three great ones.
Yep.
We have three great ones.
Three great ones.
And then a bunch of singles and doubles.
Yeah.
Maybe you got your money back, maybe you triple your money, who knows? But not home runs, not 100x, not 50x. It's hard to get a home run. And even Jawbone, which was supposed to be the big one,
just blew up 900 million and went nowhere.
It went nowhere, and they had done so good in the early days, but it seems like they got too many products concurrently. And then you just think about Apple, Microsoft, and Google, and Samsung, and how quickly they can copy a startup. Talk about how much things have changed in the last 10 years with the fact that the big technology companies are no longer dumb and slow.
I think it's really a matter of figuring out which of the ponds you're going to try and fish into, and which are the ones that you will avoid at all costs. What's been interesting with Microsoft, I was a partner of Microsoft in the very early days at my startup, and they had this roadmap that said, okay, here is the green, here is the yellow, here is the red, and they were basically telling you what they're going to invest in, and therefore you should stay the hell away. What is potentially risky and what's open field. And we used that to sort of figure out what we would sort of develop in those in those kinds of sectors. I think that now they try and do that as well. Google will tell you what they plan to do with the Google Cloud. Amazon will sort of keep everything to the vest, but close to the vest. But they're really expanding Amazon Web Services. So you're trying to figure out what is sort of the unique functionality, what is the unique technology, what is the unique insight I have that I can go deep into. And even one of those big guys comes in, it's actually, okay, look, SendGrid is not the only company sending emails.
No, Amazon has a competitive product now.
Which is cheaper.
It's cheaper, but it's nowhere near as good.
Yeah.
We compared Amazon's email service to SendGrid's, and we use SendGrid's at Inside. It's 50 times better. I mean, they're so focused. They have so many more features and API hooks that you can't even get somebody from Amazon Web Services on the phone to talk about the email product. It's just like a very generic version of it. It's sort of like buying, I'm trying to think of the most...
It's kind of a generic, okay kind of product. But the point is, it's about the experience, not only the technology. It's about the experience. And so, what you need to figure out today, what's interesting is look at Facebook and how they have expanded the the products that
and
they
copied Snapchat so fervently.
But also, they have Marketplace. They have all those sort of different products, and guess what? They have 2 billion users that they can throw their product at, and suddenly there's a button that appears, and guess what? Everybody uses them.
Everybody has eBay.
So it's really sort of challenging, especially in the consumer space, to figure out what are the open fields. And we give it a shot based on the unique insight of the founders. And what's tricky, because when you and I started, we couldn't lose. Remember those days when if all went well, we had a great outcome, and if ever someone didn't really work out, we could sort of just sell the company back for money back, or 2 or 3. Sometimes I would do 3x on a failed company. Yeah. Those days are gone. You basically
just go to zero.
It's going to zero. And so it's way more risky, and that's why you have to be way more thoughtful about which sectors, the landscape, because the big companies aren't them anymore. You can't assume that you can,
Is that because there's so many
out-innovate
companies now that the M&A departments at these companies could never absorb the startups that are dying? It's just too many.
Yeah.
There's way too many.
And they've learned their lessons as well, because they've sort of seen what it meant for them to acquire this company for 25 million, and basically within 6 months everybody's gone and they haven't done anything with the technology, and it was a waste of time and resources.
Yeah.
So
it's not even the money for them, it's really the time and resources to try to integrate it and close the deal.
So now they're pretty clear. It's like, okay, I'll give you the press release, and that's the only thing that you'll see as an investor. Interested?
Yeah.
And therefore,
what do you do in that situation?
Oh, we basically tell, because we used to ask employees and founders to stick around, right, for 2-3 years with the acquirer, because we're returning the cash or getting, some performance or profits. But now, if I get 10 cents on the dollar, so I invest $1 million, I get $100,000 back, and I'm going to ask them to spend 3 years of their life with the acquirer for that?
Yeah.
No way.
Yeah.
No way.
So you say, don't sell it and just start a new company. We'll invest in the next one. Yeah. Yeah, I've had the situation come up a bunch of times where, a bunch of times, a handful of times, 3 or 4 times, where big companies want to buy something and they give zero consideration to the investors.
Yeah. They were already cap table. Yeah.
I'm like, why would I sign off on this? And you want me to sign, indemnifications and non-disclosures. There's no reason for me to sign. I'm getting nothing. Yeah. And for me to sign, shouldn't I get something? Like 10 cents on the dollar? Would that be too much to ask? Doesn't make much sense to me.
But as an angel, whatever you get back is sort of meaningful. As a fund manager, like whether you get 0 or 10 cents is the same in the grand scheme of things.
Right.
So
you're going for the carry.
You think about the overall performance and what the deal is, and it just doesn't make any sense.
Now that I have finished my first fund, I actually look at the losses and I'm like, I know that's going to lose. Mm-hmm. It's better we just get it off the books now, wrap up the story, and move on and focus on the other one. So it's almost like if I have 10 that I'm lost faith in, and I've got 3 or 4 winners, it's like the sooner those 10 can wrap it up and move on to their next startup, the better it is for everybody.
The better it is for you, because you can focus. Because at the end of the day, we should spend all our time on our winners, but in reality, we don't. We at Uncork really want to make sure that everyone gets the support and the help. And, soft landing a company takes a long time. Trying to work out something or sort of, get it to pivot into something else or whatever, it takes a long time. That's our job. We do it. But if something has no future and everybody is agreeing with that, much better put it to rest, either return the cash or do whatever. But just not spend any energy on those and just focus on the better companies, which will actually generate the returns. Because we know, unless you're exceptional, that less than 10-15% of your portfolio will be the one that matters.
Precisely. Sometimes you just got to move on and know when it's time to move on. Today we see so many more startups than when you started 10 years ago, 10 plus years ago. How do you think about the number of companies there are and people's ability to get a Series A? Because as a seed stage investor, I'll just ask you, have you ever seen a positive outcome for you that didn't include a Series A after you invested?
So currently, no, not really. I mean, I have an exception, but the exceptions don't really matter in this environment where you actually sell a couple of companies. We had Niche that was acquired by Twitter when it was a seed stage company. We had a couple of early acquisitions that were pretty good. Chariot was acquired by Ford
before a Series A.
Before a Series A, but they're sort of the exception. So the natural sort of path to greatness is get your seed, prove that you have early product market fit, get a bit of revenue, figure out traction, bit of marketing, go to raise a Series A, which will give you 2 years of runway, try and get the best possible sort of Series A investor. Because the way to think about your early rounds is really they enable your next round. So the day you close, you start the race to the next round. So seed enables a Series A. Series A enables a Series B. And then that's when things start to bifurcate a little bit. Some awesome companies will just go break even and be profitable and won't need to raise ever. They may raise, but not for the reasons of I need to, I need to raise cash to burn. I'm basically, raising cash to grow faster. Others will still continue to raise cash because they need to, stay on the treadmill and grow their revenue and so on and so forth. It's very hard for a company to sort of succeed and have this awesome growth curve just on seed or Series A financing.
Yeah.
Most companies these days raise, tens of millions of dollars. However, if you look at Fitbit, we're talking about Fitbit. Fitbit only consumed $32 million to actually go
Amazing.
to
So efficient.
IPO. They raised 60-ish, 66.
But they only used 32.
They only used 32.
So they had a massive cushion. So that means they were cash efficient.
Oh, they were super capital. I mean,
They were frugal.
They were capital efficient, but not at the beginning. Right. That's the issue. Startup costs of a hardware company are pretty atrocious.
Yeah.
So it's really important for companies to figure out their Series A pitch. This is where you were going, and for the longest time, I've talked about the Series A crunch, which just intellectually you say you 10x the throughput of the seed market, right? You have 570 funds, you have a bunch of angel lists or whatever. So you have thousands and thousands of companies being seed funded, and they all get onto Sun Hill Road or 2nd Street in San Francisco, like trying to get onto South Park to meet a bunch of firms, and the number of Series A firms has barely changed in the last 10 years, right? You've lost some, you have some which have come up to market, but roughly it's the same number of partners and same number of firms.
So harder and harder to clear market.
So harder and harder. And, I haven't really seen sort of that drop off because those Series A firms have actually sort of responded to the market by doing more deals. But I think that over the past 2 years, we've seen sort of a normalization of the market where things get compressed. We still do extremely well. And I think this year we've had, 12, 15, whatever sort of Series A. Essentially, only one company that we tried to raise a Series A for didn't raise. Right?
Wow.
So we have a really good track record because we know what it takes to raise a Series A.
So you're thinking about that when you invest in the seed.
Yes. So it's, founders, product, market opportunity, and Series A fundability. Right. So if I don't have a good sense that something I know I can raise for this company from, a set of 5 or 10 funds, then I will likely not invest because...
Yeah. So this is what I've added to my game. I didn't think about that all that much. And that's a leak in my investment game where I was just like, VCs don't... I used to think, well, VCs don't get it now, but they'll get it later. And then I realized sometimes they're just not going to get this one. No. And then this company is going to have a seriously hard time. But I also see it as sort of and maybe I'm crazy, but I kind of feel like the VCs have raised the bar so high for a Series A, and they've said, overpay in the Series A. I'll overpay in the Series A. I hear this over and over again. Come back to me when it's a sure bet or a surer bet. And I say, wow, to myself, there must be this huge opportunity or arbitrage where they want more performance. We all invest in the companies and they just need another year and another $1 million or another year and another $2 million. But they're willing to raise at the valuation that they did last year or slightly above it. So that to me seems like an opportunity that should be emerging. Do you see that opportunity in the space?
So that's the bet that Paul Martino and his colleagues at Bullpen have, sort of singled out as what they wanted to go after, which is the post-seed, pre-A, seed prime, seed twos market. And they've done well in investing in a number of companies. And when Paul, who I've known forever, like literally even longer than I've known you, came to see me to pitch the concept, I said, but you're going to have adverse selection. Because at the end of the day, the very best companies will go through, the Series A hurdles. And the ones that fail, like, here's the hurdle, you fail, you fail, you fail. Well,
does $1 million get you over it or not? Yeah.
Right? And I think if you're very, very good at spotting like the twinners, like the one that was almost sort of going to get there, you probably will
or
be
they're going to
successful.
get there. They just need a little more time, right? Like the performance is there, but the bar has been raised so high that they just need a little bit more time.
But in our portfolio, I think that every time we sort of go through a post-seed or pre-A round or whatever, it's sort of an indicator that it's going to be tricky.
It's going to be tricky, yeah. Yeah, so the dynamic right now is one of the things about this game that we play, this pursuit that we have of early stage investing. It's always changing. Yeah. So this Series A crunch did not exist. The seed phase, as Satya from Homebrew called it recently on an episode when I was talking to him, this seed is moving into a phase. Mm-hmm. It's almost like there's a venture phase and there's a seed phase, not a seed investment, not a seed round, but a seed phase of 4 or 5 deals, and then a venture phase of 4 or 5 deals. Do you buy that? Do you find that credible?
It's kind of an interesting way of thinking about it. But if you look at this overall ecosystem that has been built from zero in the last 10 years, so you had the few super angels that were investing their own capital, and then we all raised funds in the 2007, 2010 kind of vintage, and that was the first cohort of micro VCs. And then more came, and so differentiation started to happen. And because we were successful and more people wanted to give us capital, then we started raising larger funds. And because we raised larger funds, we wanted to write larger checks. And so the interesting question is, did those seed rounds become larger because we had larger funds, or did we have to raise larger funds because the seed rounds became larger? But the point is, you certainly had people sort of wedging into the market and creating those pre-seed rounds and pre-seed funds, because I was no longer writing the first check. Right. I was writing the first large check. Right. When I got started in 2004, I was literally writing the 25K check that would help incorporate the company, get a tax ID number, open a bank account, and cash the check.
Get a desk.
Right?
Yeah.
Right? That's what we're doing.
Literally, you turn the lights on.
Exactly. And so that's what I was doing. And now we write the first large check that will help the entrepreneur get, a round together. So Uncork is writing on average $1 million check in a $2 to $3 million round, software, or $3 to $4 million round, hardware, or frontier tech, which means that we get to invest about 9 to 12 months after we did in the early days. And so that created an opportunity in the market where you have on one side the accelerators, on the other the pre-seed funds. And we have no problem investing behind, Manu Kumar at K9, my former partner, Charles Hudson at Precursor, because they do an awesome job to help the entrepreneurs go from nothing to having the beginnings of the product, right? We're not taking that early risk. The problem is that from the entrepreneur standpoint, by the time you raise a Series A, you haven't raised, 1 round, you've raised 2 rounds, so you have more dilution than you used to. And if that's what Satya refers to as the venture of the seed phase, yeah, I can see that. Some entrepreneurs will figure out bootstrap whatever, or just go straight to a seed round, but it's definitely much less often than it used to.
I'm trying to figure out, and I think that's an interesting way to look at it. I'm trying to figure out if we should be pricing the rounds earlier as opposed to convertible notes. So I've started to have board meetings earlier with companies, like start having board meetings when they hit $50K a month in revenue, and start getting them on that cadence of, here's what board meetings are, here's what resolutions are, here's what your employee stock option plan is, here's what directors insurance is. Just sort of get that infrastructure set up a little bit better to make it Series A ready. I'm also wondering, maybe we're too reliant on these multiple convertible notes that nobody knows what they own in the company, and we have to wait for this conversion moment, which is inevitably going to crush the spirit of the founder when they see exactly the dilution that they actually suffered because they don't know early on. We should start pricing these rounds earlier, shouldn't we?
Only, I want to say 15% of our rounds are safes or convert notes. Everything we do is priced equity, we'll take board seats if this is something that the entrepreneur wants us to. We'll go through the hygiene of, having board meetings and making sure everyone understands, what they do. Because the sad thing that happens or doesn't happen when you do a convertible note or a safe is legal due diligence.
Right.
You actually never go and check that the 83B election has been done properly. You never check that all the IP assignments have been done properly, which means that it's the Series A,
Cleanup.
investor that does the cleanup, and that cleanup costs a crap load of cash.
Yeah,
and
now you talk about 50, 60, 70 grand.
Or more, or you remember, I mean, it has happened to all of us when you sort of figure out, the entrepreneur hasn't signed a 83B election, which means that they're going to get taxed. So we basically wipe out their equity, give them options, have to give them loans or whatever.
Yeah.
Like how many times has it happened?
Yeah.
Too often. Why? Because there's not, unfortunately, entrepreneurs don't want to pay legal fees, so they work with their buddies who doesn't know anything about
Their
corporate
cousin's
law,
a friend who is an
whatever.
associate who gave him some paperwork.
Don't get the proper advice, and unfortunately, saving $5,000 in legal fees may cost you $500,000.
Yeah, exactly. Or it could cost you your company.
Yeah,
if you screw it up enough.
Yes.
I mean, I've seen people who vested the shares in the company to people who are no longer there. Like they vested the founder shares to.
Oh, yeah.
And you're like, who's this person on the cap table who earns 15, 20%? It's like, that guy worked for us for a year.
I've had that one of our companies. Basically, we had two founders owning 45% of the company, no vesting. And it was like, this is crazy. You guys, and someone said, they give me all this BS about why it was okay or fine. And I said, look, if you want my investment, you will have to vest your shares and put in place, option pools and everything. Otherwise, I'm gone.
Yeah.
And they said, okay, fine, whatever. Literally 3 months later, they disagree, and one of the founders goes.
Right.
Just think about the company having 45% of dead equity. Oh, it would be dead. It would
be dead, right? You're just like, okay, this is intractable. You can't get the person to give up 45%. It's too much to give up, and they can't get the other person to go to work because every dollar they make, they got to give 50 cents to the other guy who's not there anymore. It's crazy. All right, listen, Geoff, thanks for coming on the program, sharing so much of your knowledge, continued success, and everybody knows he's Geoff, just Geoff, first name club. I'm Jason, he's Geoff on Twitter.
Yes, on Twitter.
If people listening to the show are going to get the sense that everybody gets their first name on Twitter, just to correct anybody who signs up for Twitter today, there can only be one Geoff and Jason on Twitter.
You just had to be early. You
have to be early. You could be Geoff 475AF, but don't try to leave off the last F. Son. Or something, because the Russian bots have taken up all the other handles on Twitter. It's sad that Twitter hasn't broken out, huh? What do you think? Why is Twitter stalled? Is it just their natural audience, or just not bold choices? It's such a quagmire conundrum to me that they can't get that business to grow. I love it. I'm addicted.
I agree with you. I think it's the lack of leadership on the product side. I think I respect both Ev and Jack, but I think they've just had a hold on the product vision for too long.
Yeah.
And therefore,
stagnation.
Where the market has evolved, they just haven't been able to get Twitter to react. They had a very specific vision of what Twitter should be, and the fact that it took 10 years to get 280 characters, and they still don't allow you to freaking edit a tweet. And for the reason that, in the early days, you sent an SMS to do a tweet,
that was the reason
you couldn't did it. Now, I think there's always sort of the notion of, well, if you send a tweet and, you then edit it and you have a bunch of people react, what does that mean? So, okay, fine, whatever. But I think it's lack of product leadership. And then this notion of, okay, well, what are we? Because Twitter is so important, right? But it's weird that they haven't been able to build a business.
I think they should have been a collection of brands, because Twitter, I think, has a natural audience that loves it. But I thought they were doing so well with Vine, Periscope, and that they could have been a collection of apps,
of services and apps, and different experiences.
Yeah,
I mean, candidly, that's exactly what Facebook is doing, right?
Right.
Between Messenger and Instagram.
I would have taken the DM out of Twitter, because DM is such a powerful concept, and made an app called DM, just direct messages. A separate direct messages app would probably have more usage than Twitter itself, because more people talk to each other one-to-one or in groups than they do on Twitter publicly.
That is
right?
probably true.
And you could make an entire app where 100% the UI and UX and
I
everything.
would have, and I think the product experience and a stronger identity.
Yeah.
Because, unfortunately, as Jeff, I get all the tweets addressed to Jeff Sessions, Jeff Bezos, because it's like at Jeff space and then
underscore. I get all Jason Isbell.
Yes.
I get all of Jason Mraz, whatever his name is. Jason Bateman, Jason Statham.
This is sort of where the first name basis, Twitter accounts. So
it's worse on Instagram. I literally can't look at I had to turn notifications off on Instagram because it's all kids in Malaysia or Singapore or China or South Dakota are like, at Jason, check this out. And I'm just like, it's a person on their skateboard in their backyard dunking a basketball. Who is this person?
Well, because they don't know. Like for them, they create this sort of friends group and they address each other as, at Jason, at Jeff or whatever. What they don't understand is the broader identity and the fact that it's not that Jeff or that Jason, it's us.
I get added to private chat groups on Instagram with like 15-year-old kids in all kinds of different cities talking about all kinds of crazy stuff. And then sometimes I'm like, I really don't need to see this. I got to get out of here. Like kids smoking weed, doing all kinds of stuff that kids do. All right, listen, follow Geoff. Go check out uncorkcapital.com. Just one of the great firms in the history of the modern history of Silicon Valley, I should say. Continued success. Congratulations on 5 funds.
Thank you.
We'll check in with you again when you hit 7. We'll do our, every 7-year check-in here at This Week in Startups. I'm sorry, Angel Podcast. You were last time, I think, on This Week's Startups. Hey, if you love the program, go ahead and rate and subscribe and write a review on iTunes. We're also on Spotify. Thanks to my friends at Spotify. Thanks, Daniel, for setting us up. So you can find Angel, the podcast, on Spotify as well. And Overcast, we don't have any formal relationship with them, but boy, that's a great product. So check out Overcast. You can find us in Overcast, TuneIn, and SoundCloud and YouTube. Okay, we'll see you all next time. Bye-bye.